There has been a 35% drop in housing, the worst decline on record. The housing market has been dropping for 4 straight months, and experts predict it will continue to decline. It's important to understand the latest housing market forecast and ways to take advantage of the downturn, whether you currently own a home, thinking about buying one, or just want to understand the market. In 2023, the housing market is expected to be challenging due to a number of factors. Firstly, interest rates have risen at a fast pace and are currently at similar levels as the early to mid-2000s. However, median home prices have risen to $454,000, which is not matching the median income. Secondly, consumer spending has decreased, meaning people have less disposable income to spend on housing. Lastly, the rising unemployment rate is an indicator of a recession. As inflation increases, people have less disposable income and companies have weaker earnings, which leads to job cuts. This results in less upward pressure on housing prices. Additionally, there is more inventory of homes listed for sale, with a 15% year-over-year increase, the largest on record. However, the median sale price is only up 1.5% from a year ago, all of which is likely to lead to a continued fall in housing prices over the next year. According to the National Association of Realtors outlook for 2023, home values are expected to remain relatively unchanged from today, with some small price gains in some areas and declines in others. Additionally, mortgage rates are expected to fall and settle around 5.7% by the end of the year, leading to a more normal housing market. Realtor.com predicts that home prices will increase by 5.4% in the next 12 months, driven by low inventory. However, their forecast for last year was off by more than 7%. Zillow predicts that price declines will be moderate across the country, with vacation destinations likely taking the biggest hit. 2023 is expected to be a year where conditions begin to favor the buyer. However, some areas may continue to see appreciation. CoreLogic forecasts that housing prices will continue to rise by another 4.1% through October 2023. But this should be taken with a grain of salt, as they often adjust and correct their numbers on an almost monthly basis. The consensus is that appreciation is local, with coastal markets likely to see a 5 to 15% drop, while other areas may stay the same or even get more expensive. One interesting aspect of the housing market is rental prices, which are generally stable and tend to be a lagging indicator during bad times. For example, during the 2000 financial crisis, rents increased and didn't begin to drop until a year after the recession ended in 2010. This was because as prices fell and people were losing their homes, many of them chose to rent, which drove up the price. However, prices began to fall again once those tenants started buying properties of their own several years later, as the cost of owning was cheaper than renting. Today, something different is happening, with RealPage finding that national asking rents dropped by 0.59% in November due to a lack of new household formation, and not because renters are becoming buyers. Markets like Phoenix and Las Vegas were the first to see year-over-year declines in rent, with the rest of the country beginning to follow. According to RealPage, apartment construction is at 40-year highs, with more than 917,000 units currently under construction, expected to be completed by the end of 2023. However, there is a surplus of supply and not enough demand, resulting in declining rents. However, it's important to note that rental market conditions vary by location, with Oklahoma City experiencing the fastest 24% rent growth in the country. Meanwhile, other areas such as New York, Milwaukee, and Minneapolis are seeing some of the largest declines in the country. Additionally, renting is still cheaper than buying in most of the United States, with 38 out of the 50 largest metros being less expensive than owning. Furthermore, it's worth mentioning that less than 50% of landlords raise rent by more than 3% as the economy begins to slow down. An analysis of data shows that most of the reported rent increases are due to tenant turnover, not increases on existing tenants. Many landlords are simply trying to bring their rents back up to the current market value. However, this does not mean that prices will not be increasing at all, as 75% of landlords said that they intend to raise rent, at least somewhat. Additionally, smaller landlords are less likely to raise rents during the renewal period, since a vacancy would have a larger financial impact for them than for institutions that spread the rent throughout hundreds or thousands of units. Even though 2023 could be more expensive, if you are currently paying under market value, the good news is that if you are looking for a new place to rent, it's likely going to be a lot cheaper than it was a year ago, with prices continuing to fall. Lastly, it's worth noting that the home sales have slumped by 35%, which was the biggest decline on record. However, it's important to understand that home sales do not necessarily correlate with lower prices. The decline in home sales is mainly due to the fact that during COVID, fewer people were selling and fewer people were buying. Data from Redfin shows that there are 18% more homes on the market today than a year ago, and those same homes are lingering on the market longer as buyers take their time. Purchase applications are also down 36% from a year earlier, signaling that buyers are waiting for conditions to improve, which could likely take another 6 to 24 months. Real estate investors and landlords believe that 2023 will see the delayed effects of a slowing economy in terms of rents. They believe that higher interest rates, weaker consumer spending, and continued layoffs will put a lot of pressure on landlords to retain their existing tenants or reconsider their planned rent increases, as there will probably be more inventory hitting the market. Additionally, they have observed that some home sellers are deciding to rent their homes because they can't get the price they want and they don't want to give up their low interest rate mortgage. As more people do this, it will give tenants the upper hand to pick and choose where they want to live, and landlords will have to compete with each other for a limited pool of tenants. Regarding home values, it's believed that home prices take a long time to adjust, and not like the stock market, where one comment can cause a free fall. The housing market is similar to the temperature in a pool, where if you turn it up, it will take a while to heat. When payments increase, only new home buyers are affected. Everyone else who has locked in their loan probably won't sell unless they absolutely have to. Because of that, it will probably take about 12 to 18 months for those new prices to really take effect. Thus, a mild drop is probably the most likely scenario, with some of the harder-hit areas declining by 10 to 15%. However, accurately predicting anything is really a shot in the dark. That's why it's always best to only buy what you could afford with a fixed-rate mortgage that you intend on keeping for at least 7 to 10 years. And after that, you could subscribe if you haven't done that already.